Welcome to the broadcast. Today we have with us CFSI, Core Innovation Capital, and Morgan Stanley to present the 2014 Underserved Market Size Study. Please let me introduce you to Moses Choi, Vice President of Global Sustainable Development at Morgan Stanley.
Hi, thank you, Eva, and thank you all for joining today's webinar. Today's discussion continues an ongoing partnership among CFSI, Morgan Stanley, Core Innovation Capital, and brings you a first look at the latest market trends impacting the financially underserved. And we are joined today with Eva, who is the principal author of the report that we'll be discussing. This annual report, which measures how much underserved consumers spend to conduct their financial lives, illustrates the size of the opportunity to address their financial needs in the variety of products and services used to borrow, spend, save, and plan. Thanks again for joining. Next slide, please. I'm joined today with my colleagues, Colleen and Eva, who will share a little bit about themselves momentarily. But just to kick off, my name is Moses Choi. I work in the Global Sustainable Finance business at Morgan Stanley, where we incubate, originate, and execute transactions or business development initiatives that reach market rate risk-adjusted returns and also have a material social and or environmental impact. We are focused on proactively commercializing opportunities related to fintech, consumer and small business, and look across the spectrum in both debt, equity, our wealth management business, investment management businesses. Colleen and Eva?
Sure, thanks, Moses. Hi, everyone. Thanks for joining us today. My name is Colleen Poynton. I'm a Vice President of Core Innovation Capital. Core is a venture fund that is focused exclusively on financial services and financial technology. We've been investing in this space since about 2011. The first fund was kicked off, and we're now in our second fund. We invest in companies that we think are not only massively scalable, highly competitive, and extremely advanced from a technology perspective, but also deliver extreme consumer value to the end user. So we look for companies that we think are leveraging technology to better price risk, more efficiently distribute products, and architect products and services that are better for the end consumer. So we look at all across the spectrum of financial services that we'll be discussing today, everything from payments, credit, savings, and investments. And I'll let Eva speak a little bit to CFSI.
Thanks, Colleen. I'm again Eva Wolkowitz. I'm an associate at the Center for Financial Services Innovation, often known better as CFSI. And we are the nation's leading experts on financial health. And as such, we lead a network that is dedicated to working to support financial health in the United States through the development of products that can better serve the needs of U.S. consumers. I personally work on market sizing every year, such as the report we're presenting today, as well as other topics in the financial technology space.
Great. Next slide, please. So this partnership dates back to a series of reports that started in 2012, which included the annual Underserved Market Sizing Report. Since then, we've partnered together and have released reports related to various fintech trends, investment activity, the role of big data and analytics, all with the purpose of identifying opportunities and trends within the financially underserved market. Eva is going to be going into depth regarding the report itself, but I just wanted to make a couple of just sort of brief introductory observations as a way to sort of kick off a discussion, and then hopefully we can tie back to some of those. And these are not necessarily views of Morgan Stanley, but sort of trends that I'm seeing in the market. So first, while marketplace lending is still relatively small within this particular segment that we're discussing today, it is growing rapidly. Importantly, we have seen increased partnering between banks, as some of you on today's line may know. The OnDeck and JP Morgan partnership was announced this week. And it's really sort of in sort of my view that banks will be continuing to structure partnerships to deepen opportunities together with marketplace lenders for the purpose of customer acquisition, sourcing loans, etc. Marketplace lenders have gained, enormous amounts of credibility over the years, and so we're seeing lots of banks getting interested. What's also interesting from a sort of underserved perspective is that some of these marketplace lenders we anticipate will be providing some more flexible products in terms of effective yields and so we're sort of excited in some respects to see that from a kind of a social impact perspective. Other partnerships in the market include, of course, Lending Club and Citi, with Bank Alliance, On Deck and BBVA, etc. Another quick observation I wanted to make is about sort of credit more broadly, and just wanted to say that the aggregators of the world are going to continue to bring more efficiencies to credit scoring. Recently, Credit Karma announced their product called Direct Dispute, which allows consumers to clean up mismanagement of the credit files, and we think that's an exciting space. The last thing I'll just note is that within kind of personal financial management, one area that we would love to see some more activity around is how potentially fintech startups can help consumers manage and avoid shocks. It's something that I know CFSI is looking into, but as most folks know, when there are shocks, the sort of cost of small dollar credit is disproportionately high for this particular segment and impacts their sort of overall health, and we'd be delighted to see sort of more activity and look forward to some future research that CFSI is putting out in that space. So all that to say is welcome, and we look forward to sort of really diving in. Over to you, Eva.
Thanks, Moses. So in this year's report, we are really focused in on establishing the size of the market for financial products and services utilized by underserved consumers. And that means studying the interest and fees that consumers spend that becomes revenue for the market on products they're using to borrow, spend, save, and plan. We also look at the volume of consumer activity to make transactions, take out loans, and such that generates this revenue, and then the rates of growth year to year that each product exhibits in terms of revenue and key trends driving those growth rates. The report also has a full appendix with details about each product covered separately at the end. The highlights of this year's report are as follows. In 2014, the underserved market generated $138 billion in revenue, and this was based on a volume of consumer usage of $1.57 trillion and represents growth of the revenue of 7.6% annually between 2013 and 2014. Over the years, this market has continued to grow since we first began measuring its size in 2009, moving at about a rate of 6% compound annual growth per year. It's projected that by next year, in 2015, when we size that market for the following year's report, we will be at about $147 billion, up from $138 this year. As a reminder to everyone on the phone, we encourage you to type questions or comments at any time during the broadcast, and we will be reserving the last portion of the hour for questions and answers from those we receive. So now we should step back and consider for a moment what it means to size the underserved market. Who is in this market, and how do we decide what to measure when we constitute the products and the spending that we focus on here? The underserved market encompasses consumers who both use alternative financial products, estimated by the FDIC at 68 million individuals in the U.S. It may also mean that they have subprime credit scores, thin or no credit files, which through Information Advantage score we estimate at about 108 million. And it may also mean that they find their access to mainstream financial products challenged by low to moderate incomes or significant income volatility, which we estimate based on census data and Department of Labor data at least 79 million people. Now, individuals who are underserved may experience all three of these challenges, or they may only experience one or two of them. But overall, we look to products that they use based on these kinds of underserved challenges in their lives, or mainstream products used by folks experiencing these challenges. There's also, beyond the underserved market, a vast opportunity to support those who struggle with their financial health in other ways, those who are underserved and others beyond who see their day-to-day financial management, their ability to be resilient in the face of financial ups and downs, or their ability to plan for the future and seek opportunity challenged by their financial circumstances. And a little later in the broadcast, we'll explore some ways to look beyond the underserved market and more of those folks that are struggling financially. I'll also note here that this report is a current scan of the market, and as such, it should not be taken as a statement on the appropriateness or safety or level of quality of any product that we cover here today. And also due to the heterogeneous nature of the products we cover, and there are 26 of them in the report, there's going to be differences in the models used to generate fee revenue and methodologies used by the study to identify that revenue. And so we do not recommend the report being used as a reliable measure of fee percentage, since there are many different products and models included in the report altogether. And we should also note that product size and growth does not necessarily work synonymously with levels of innovation or quality, although it may at times. So product growth may or may not mean that the product is better or worse for consumers in the market. That's a separate question to consider. The highlights from this year's report of $138 billion spent in consumer revenue break down into 5 main categories. These are single payment credit, to your left in blue, and those are products that are credit products due in one lump sum, usually in the terms of 1 month or even less, like 2 weeks, and include overdraft protection fees, pawn and payday loans, and refund anticipation checks taken out at tax time. In the gray column, second from the left, we size short-term credit. And short-term credit is, unlike single payment credit, due in installments or else on a revolving basis. And that includes installment lending, secured and subprime credit cards, auto title loans, and rent-to-own products. In the center, the orange column shows longer-term lending. And these are products that are due over a longer period of time, usually at least 2 years, if not more like 5. So these products include auto loans, private student loans, and new this year in the report, personal marketplace lending loans. In the green, you can see payments products. And these include all transactional products such as prepaid cards, money orders, and remittance, check cashing, those sorts of things. And finally, in the purple, deposit products and a few others such as tax preparation and fees paid to borrow against retirement plans. The single biggest category, or the single biggest product revenue, I should say, of all of these this year was overdraft, which itself constitutes $23 million in consumer spending by underserved consumers. And the second biggest, at just under $23 million, is subprime auto loans. Overall, however, as a category, long-term credit at $48 billion is the largest category this year. Now we'll take a little look at how these products have grown over the years. We can see that both long and short-term lending in the orange and gray are growing at a pretty substantial rate. In fact, in the past year, they each grew 15%. Well, we can also see that the blue row, the blue line there for single payment credit, has stagnated over the last few years and in fact shrunk by 0.5% in the past year. This is a significant trend that we go into detail with in the main report. because these two product categories together are on track to, in the future, converge and then actually see more revenue coming from single payment credit rather than from, or rather, more revenue coming from short-term credit rather than single payment revenue. Because while single payment revenue still draws more dollars in 2014, it's actually declining or staying steady over the past 2 years, relatively speaking, while short-term credit is growing at quite a clip. Some of the factors driving these changes include regulatory pressures and anticipated changes coming to single payment credit products such as payday that have caused some providers to shift to installment models, as well as a plateauing of overdraft fee spending by those who overdraft most frequently over the past few years following the CARD Act and opt-in rules for overdraft. Whereas short-term credit has seen growth in installment lending, as well as continued growth over the past few years in how credit cards are marketed and offered in terms of subprime rates and folks that are looking for credit further down the scale. There's a lot of available capital there. And I want to actually pull in Colleen here from CORE to hear a little more from her perspective about the significant trends of shifting credit more toward installment and revolving models and away from single payment models.
Sure, yeah, happy to speak to this a little. Yes, it's interesting. It's a trend that we've definitely recognized, I think, across the industry, both from the perspective of kind of new energy and new entrants into the credit space in terms of folks trying to design and build kind of better credit products for the down market, underserved consumer. So that means, you know, kind of fully amortizing installment products as opposed to the single payment that Eva described. And, you know, as well as more mature players who I think, frankly, have been reading the tea leaves, so to speak, in terms of looking at the regulatory headwinds, some of which Eva has described, and really beginning back several years ago, you know, looking at Operation Choke Point, which was trying to tap down on capital that was flowing into, you know, payday models, as well as more recently this year, the CFPB announcing plans for rulemaking around the single payment and short-term credit space. And I think what's really significant here is if you look at kind of the proposed rules that the CFPB is laying out, these are topics such as limiting the number of renewals that a payday or single payment customer can take out on a loan, limiting the number of rollovers, and discussing potential for kind of mandatory cooling off periods, so a mandatory period of time between subsequent string of loans. And those are extremely, you know, significant in this market because just kind of a broad characteristic that we observe and that frankly everyone has to confront, whether you're a startup that wants to be active in the alternative credit space or an established player, is that, you know, the shift to online distribution comes with a fairly material cost of customer acquisition, especially kind of relative to the size of these loans, which are usually fairly small. And so for the economics to kind of work, in many cases in the single payment category, you really need to be able to deploy kind of subsequent loans to a singular borrower. And I think it's something around 2 to 3 loans before you can recoup the cost of acquisition and begin to turn a profit on that customer. And so if you think about, you know, the imposition of mandatory cooling off periods that effectively force reacquisition of the same customer, or you know, a cap on the number of subsequent loans that can be made, the economics of these models start to break. And I think that has really helped kind of fuel the trend in the industry, even among more established players that traditionally offered heavily just single payment products are now beginning to roll out more kind of term loan, fully amortizing options. And I think that reflects the shift. And so, we certainly expect both in terms of new entrants, startups such as, LendUp or a portfolio company of ours, Opportune, that are structuring, small dollar credit at much lower rates and in much more favorable terms in a much more kind of pro-consumer manner. We certainly expect that to be, much more the norm of, competitive products that are mitigating regulatory risk moving forward.
Thanks, Colleen. Those are all great insights to consider, since this is an ongoing shift that's going to continue to happen. And I think year to year we're going to see more and more of those factors come into play. And there will also be probably some unexpected things along the way as we see how some of those regulatory changes and market responses play out. So next, I want to apologize. I think we're having a bit of a slide issue here. So let me ask actually if our slide controller can take back the control from our main office and run them from there for a moment. I think that might look a little better for all of us. Well, I'll go on in the meantime, though, to discuss the next point as we're fixing that slide issue for you there, and discuss a little bit about individual product growth we've seen in the past year. At the high end of growth, most significantly in terms of year-to-year changes, has been marketplace lending, which has in fact grown over 300% just in 2014 alone. And that product, while still small at only 0.6 billion out of 138 billion revenue in the market this year, has been growing very quickly year on year as it breaks into the market. So I think we're ready now to move to the next slide. And you can see there what I was just mentioning about marketplace lending being the highest growth rate product this year. And then a little further down the scale, we can see that there's also high growth for subprime auto loans at 34% and subprime credit cards at almost 25%, and so on, going down the scale there. One significant thing to point out, I think, is that even though we see overall 7.6% growth in the market this year and quite a bit of products that are growing quickly, almost half the products here declined by at least a little bit, ranging from less than 1% for overdraft all the way up to nearly 10% for government benefit prepaid cards. So certainly not all these products are moving in the same direction. There's quite a bit going on in both directions there. And it might be significant also just to note that quite a few of our payments products in the green are in that category this year, products that are actually have declined a little bit in terms of the revenue consumers have spent, although not necessarily the amount of consumer usage. Colleen, what does that signal to you looking at the rates of growth and decline for some of these products in the market this year?
Yeah, I mean, I think it's interesting to kind of decouple what we're seeing in terms of overall revenue growth versus overall utilization. And I think it's interesting when you see categories in payments where utilization is actually continuing to increase, but revenues are shrinking. And I think that points to, frankly, over the past several years, increased entrance in the space, deploying new technology, whether that's online distribution, or better kind of cheaper mechanics for getting cash in and cash out of payments instruments, kind of mobile-first vehicles for remittance, whether domestic, peer-to-peer, or international. And those players, even if they continue to represent a relatively small share of the market relative to the established incumbents in the payment space, they have succeeded, I think, in putting some downward pressure on margins. And that is something that we absolutely expect to continue as we look at kind of the underlying technology that is coming to market today in the payment space that will really take kind of the marginal cost of transmitting value and in some case even performing currency exchange very, very low, like an order of magnitude beneath what we see today. And so, I think even as utilization grows, I'd expect to see in the long-term compression in revenues. And then, I think, the other thing that's interesting to note here is actually, looking at products that we think of as fairly antiquated, such as pawn and auto title loans, which is sort of I would say the ugly little brother of the HELOC, right? The home equity line of credit. These are essentially, collateralized loans that allow you to tap into equity that you built in an asset. And they're often really kind of looked down upon as a product category and have not seen significant levels of innovation. Those are two areas where we do not see startups kind of beating down the door to say, I'm going to design a better auto title loan or I'm going to innovate in the pawn category. There's been relatively little of that. And I think it's interesting to see that there's clearly still consumer demand for those products. And there's clearly a lot of margin there to be gained, and frankly, efficiency to be gained. If you look at auto title, for example, just one industry leader kind of using as an example something around 60 to 66% of total revenue goes just to covering overhead and OPEX of the brick and mortar distribution channel. So, how can you begin to think about advancing that product category to basically allow individuals to access, better revolving credit lines or kind of, better, term structuring for the equity that they built in the asset and potentially, begin to introduce greater underwriting to products that effectively today have no underwriting. So I think those are just two interesting areas where we would be curious to see kind of more innovation. And then the last thing that kind of hops out at me, which is funny because it doesn't jump out from this chart, but the overdraft component, it's basically holding steady there, not slight decline. But going back to the earlier chart that you discussed, Eva, that kind of showed the overall magnitude of these segments, the size of overdraft is pretty stunning to me, and I think it touches upon a point that Moses raised earlier around shocks and what can companies do to help consumers avoid those shocks and avoid getting into a place where they either need to pursue a short-term, extremely high-cost credit product, or effectively do so inadvertently through an overdraft mechanism. And that's an area where if you look at the market, I think there was around $32 billion last year in overdraft, and so the underserved market accounts for 20-some of that, and that suggests that there's anywhere around 8 to 10 billion that's accounted for by kind of fully served non-down market customers. To me, that really suggests that income volatility and exposure to shocks is a problem that is increasing at large across the American population. And I think that reflects really, shifting kind of underlying dynamics in our economy, in our workforce, and in the nature of the volatility in individuals' income and expenses. And I know CFSI has done some really interesting work along those lines recently, Eva, and I look forward to seeing more research that you are releasing in the future on those topics. But I do think that's an area where, kind of intelligent cash management solutions, forward-looking cash management solutions, and kind of, smaller, more incremental deployment of credit to smooth cash flows can really help bring down that segment and allow people to better manage their finances and avoid those shocks.
Thanks, Colleen. And I just want to call everyone's attention to also, you can see here some of the products highlighted in red are some of those more traditional model products we just discussed a little that maybe rely more on storefronts or cash usage. And in this day and age, there's more and more opportunity to innovate within those product categories as well as compete with them and find ways to incorporate them into some of what people are using. So I think it's significant to see that they're still quite popular. Some of them are growing, and for the ones that aren't growing, there's a little bit of decline, but nothing very swift. And in fact, for remittance, I should point out, it took a bit of a dip in revenue this year, mostly because of more competitive pricing. But next year, it's expected to rise again because underlying both the dip this year and expected rise next year in revenue for remittance is continuously increasing consumer usage and volume of money sent abroad. So that one is a bit of an anomaly that went down this year a little bit due to some more significant and temporary price dips. So we advance to the next slide. Another aspect to discuss here today is what I mentioned earlier about looking at folks beyond the underserved market, in fact. So in the report, when we talk about subprime auto loans revenue, that's based on a balance in that orange wedge there of $170 billion in outstanding auto loans for those of subprime credit scores. And of course, there's the larger market out of a total of $789 billion in outstanding auto loans, much of which is for people with rates above about a 660, which is our cutoff point there, or 600 rather, which is our cutoff point for subprime auto loans. But looking at the overlay gray wedge, we see that a significant, if smaller, portion of auto loans are delinquent by 30 or 60 days, and that adds up to over $23 billion. And that $23 billion that's delinquent is not only in the subprime category, of course. There are quite a few folks, in fact, almost $15 billion of delinquent loans accrues to those with scores over 600 in the prime range of auto loans, not just those in the subprime range. So, given that those folks that are falling behind on their auto loans, even with prime scores, may soon be in the subprime category, or at least, at the very least, are indicating that they have some struggles with their financial health. This is just one product category and one indication within it of further opportunity to develop products that can support financial health better and, address some of the challenges consumers might have, whether it's with their cash flow, whether it's with the amount of credit and terms of credit they're best able to service at this time, that could be, better oriented toward them, because clearly the loan they have right now is not something that they're able to keep up with in a healthy way if they're falling behind. And so the report also details a few areas, such as this one, that really looks beyond the traditionally underserved market that we size here to explore what that further opportunity is, since financial health and financial health challenges can mean more than just folks that are underserved, although underserved makes up a large portion of those financially struggling and is some of the most significant opportunity there.
Yeah, this is a fascinating statistic to me, just to kind of hop in here, Eva. I think, the fact that a huge majority of delinquencies are actually attributable to prime borrowers says a lot about kind of the underlying mechanics of distribution in this market. And if you just kind of think about how folks procure an auto loan and kind of what categories of loan originators are seeing growth in market share relative to others, and then kind of how those originators skew with respect to their risk appetite and their target yields. We've seen, I think, pretty significant growth in kind of the non-bank finance players in the auto market. They're extremely well capitalized. Their sources of capital tend to be private equity and folks that have much higher kind of hurdle rates, much higher risk appetites, and so it's really kind of pumping capital into the subprime space and frankly allowing kind of greater levels of deployment into that category of consumer. And I think it's interesting just to kind of pause and think about how the circumstances in which one gets an auto loan, right? And it often involves kind of walking onto the lot, finding a vehicle that you're really excited about, maybe getting convinced to have some upsells or some added features, And then the question is asked, well, how do we fit you financially into this vehicle, right? Like how, okay, so this is the car you've fallen in love with, this is what you want, and so now we're going to try to, quote, fit you into that vehicle. And what we've seen in following this space, because Core is a little bit obsessed with auto, we've seen that the average amount financed has increased over the last several years. The average term of the loans have increased, and the average APRs have increased. And this is true across both new and used categories as well. And so what that really suggests is that folks are being kind of fit into larger cars, which means effectively their payments are increasing and their payments are being stretched over a longer period of time, and that it seems is contributing to strain on borrowers both in prime and in the subprime category. And so, could you imagine a mechanism of distribution where you get pre-qualified for really what the loan that you can afford to repay, and then with that through qualification, the inventory that is the best fit for you from a financial perspective is kind of the inventory which you select from, right? And that kind of just shift in consumer behavior around the purchase of the asset and the combination of the financing, we think might be an interesting way to kind of get people into financial products that are more affordable for them. And yeah, I think it's an area of really huge opportunity, but this is definitely a product category where you simply cannot separate the underlying financial product from the channels of distribution and kind of the mechanics of the asset purchase. They're just very closely intertwined.
Thanks, Colleen. I think now we're going to move on to the next slide, which should take us to the Q&A portion of the discussion. And at times we may toggle back to some of the slides we discussed previously if they will, be illustrative as we answer some questions here today. So I'll read some questions out loud that we're getting from all of you typing in, and Moses and Colleen and I will do our best to address them. So one question that I've seen come up from a few folks is, we've heard a lot about the impending changes in interest rates that may finally be raised in the near future. Now, of course, this report is always looking 1 year back, so we're currently sizing 2014 and projecting rates for 2015 of product growth. So what happens in 2016 is a little further off, but certainly if interest rates increase, that's going to be kind of a big deal overall in the economy and will affect a lot of lending products, at least mainstream ones. So the question here is, will prospective interest rate increases impact the products used in this market by underserved consumers? And if so, how do we think that might happen? How might that manifest itself? Moses or Colleen, do you have any particular thoughts there?
Yeah, I'd be happy to offer some thoughts. And actually, Morgan Stanley has done some really great research in this area as well, kind of looking at interest rates in the context of growth in marketplace lending and just kind of that piece of the dynamic in fostering the exponential growth of that segment in the last few years. I mean, I think that rising rates always does have an effect. I think that in the context of marketplace lending, for example, what we're seeing is all-time lows in rates, which means that kind of the minimum return acceptable to investors is lower than it otherwise would be when the base rate is higher, and we're seeing fairly high credit card rates despite the low interest rates, and fairly low loss rates actually in credit card category, which means that there's a pretty nice wedge that marketplace lenders can effectively kind of arbitrage, and can provide refinancing on outstanding credit card debt at a discount to the borrower, and still offer a really healthy premium to the investors on the back end. So if rates rise, that wedge will decrease. I don't think I think it's really important to consider orders of magnitude here, and think about kind of the pace of the rise in rates and the magnitude of the rise. And I think that where we sit in the market today, at least in terms of dynamics, there's enough of a spread there for that, at least the marketplace lending category, I think, to be reasonably healthy in the near term. unless you were to see, say, a subtle rise in rates combined with suddenly, significant increases in loss rates in the credit card category, which is obviously, the primary driver of refinance on these marketplaces. Those two things combined perhaps could really kind of narrow the spread available to marketplace lenders. But I think in the near term, it's going to continue to be fairly healthy. I think it's possible, in some of the more subprime categories where we're seeing, heavy entry by private equity and hedge funds. So, as I mentioned earlier, a lot of these non-bank financial players in the subprime auto space are very well capitalized from private equity. As rates rise and, they can perhaps find, relatively equally attractive and lower risk yield elsewhere, they may, money may gravitate in that direction. But again, I think in terms of order of magnitude, we would need to see a pretty steep rise in rates coupled with significant increases in losses in a lot of these product categories to really see a flight of capital to safer assets.
Yeah, and I would just piggyback off of that just very briefly and say that, the staggering of the rate increases by the Fed, is going to be in a very stepwise approach, and therefore a lot of the pricing of these types of instruments will be done accordingly through the market. That being said, I would generally say that some of the larger, broader macro issues that are facing the global economy perhaps may have more of an impact in terms of overall sort of GDP growth in Asia and China in particular. Some of these macro issues may have more of an impact to sort of the global economy, and then vis-a-vis that, the U.S. and then in the U.S. the local markets. All things are cyclical, as we all know, and so one thing that we do want to continue keeping an eye out around are what may happen over time with regards to servicers. So the whole collection space, again, things are cyclical, and so we'd want to see over time as people, and consumers have delinquencies or are in a position where, perhaps it's an unfortunate position, but we do want to see a better fintech opportunities that help those consumers through that process. So I'll pause there.
Thanks, Moses. And I think really, just to add even more color to some of what you both were saying, when it comes to the scale of interest rate increases, I think everyone expects that they will be, pretty mild at first to not give too much of a shock to our market. But when we're talking about something like subprime auto loans, the average rate has been hovering between 11 and 13% for subprime consumers, and then deep subprime goes up towards 16, 17, 18% interest rates. So with those kinds of rates, a change in a quarter or a half of a percentage point in the market probably won't have a huge impact in and of itself. I think the bigger question is what Colleen mentioned about whether the capital backing some of the eagerness of the folks, especially in the credit card and auto realms, to continue lending further down the scale may shift elsewhere. But there's also been a lot of investors that have been waiting for the right opportunity to get back into some of these markets, be they mortgage or auto or credit cards or others. So as equity also comes back into the market and has been filtering back in over the past few years, I think that, in many cases there is a chance to increase the pie overall in terms of the investment that is out there and available to plug into consumer loans, and not only a sort of a closed system where money can shift one place to the other. So moving on to another great question that we got, I think we can see here obviously that investors and a lot of the folks that we hope will do more innovation in the underserved market and serve these consumers have to be motivated to some degree by the revenue they wish to earn. And in a system like this where scaling and revenue are really important to seeing viable products, the question is that at odds with supporting the financial health of underserved consumers? And what examples might there be of innovations that increase revenue while also helping underserved consumers succeed? Colleen, I thought you might want to speak to maybe one of your portfolio companies about that kind of question.
And so just to clarify, the question is, how do you grow revenue while also being kind of pro-consumer?
Exactly. How do you support underserved consumers to build better financial health and find examples of doing so while also increasing revenue and scale?
Yeah, absolutely. So, I mean, I think every company that we invest in, we invest in from the mindset of both, an institution that cares deeply about kind of the financial health of the end consumer, but also as an investor that has a fiduciary duty to back companies that we think are going to be wildly successful from a financial perspective. And so we really, take both of those mandates extremely seriously. And so I'm happy to say that we actually come across many companies, including those in our portfolio, who we think are both wildly pro-consumer as well as extremely scalable, extremely capital efficient, and are generating significant levels of revenue. And so I think the question here, and I think what the question was getting at was sort of around competitiveness, because we've been talking a lot about, cost reduction, and so I think perhaps what the question is getting at, how do you reduce costs and for the end consumer while still, being highly profitable? And a lot of that comes down to looking at margins, right? It comes down to looking at, how much of the revenue you're taking in is being eaten up by the marginal cost of customer acquisition or servicing, or what is the intensity of your fixed overhead that you need to cover, right? And so if you can deploy technology either to service customers more efficiently, to acquire them more efficiently, to run your internal operations more efficiently, such that you need fewer personnel per per loans deployed or per customers reached, that allows you to be more marginally competitive relative to incumbents. And so really innovating around the margin piece basically allows more of your revenue to accrue to the bottom line and actually becomes more about profitability than simply top line growth. And I think that just to speak to a one company, for example, in our portfolio that many of you may be familiar with is a company called NerdWallet. And NerdWallet is effectively, we would describe it as sort of a bank rate for millennials. It's an online portal for information on a wide array of financial products and services, and it is extremely pro-consumer in that they, do not kind of prioritize products and services based upon back-end compensation from those companies. They actually take a completely neutral approach in terms of very objective analysis of the products. And what we've seen is, as a result, the content that they produce, the information that they share is, widely regarded as accurate and as citable, and as a result, they're kind of highly cited, highly referenced across the web, and customers find them very easily. They see, very robust kind of conversions on the products that they discuss and recommend on their website, because they've established consumer trust around being, objective and unbiased, and that translates to them in extremely generous kind of third-party affiliate fees for those end products and services that consumers find, learn about, and then ultimately go on to purchase as a result of NerdWallet's content. So, I mean, I think that's a great example of a company that is acquiring customers extremely efficiently because of highly regarded, high quality, unbiased content, and at the same time they're growing extremely fast and they're extremely profitable. And so that's just one example. I could speak to literally every company in our portfolio, kind of the way they're approaching leveraging technology to kind of hit on some part of enhancing margin and scaling more rapidly, but that would just be one example.
Thanks, Colleen. I'll give one example as well from CFSI's Financial Solutions Lab. We have 9 cohort companies right now that are in the Financial Solutions Lab, funded by Choi. And one I would point out that I think for this discussion is a great example, although they all, I think, are designed to address consumer need to support financial health and are doing that with a goal of scalability and profitability, is that one called Ascend Consumer Finance, which is based in San Francisco. It's a great example of the proposition we're talking about here, because what they're looking to do at Ascend is really identify consumers that have lower credit scores but are looking for credit and might only otherwise face the choice of taking out a very high-cost loan, which is not good for their financial health, or foregoing credit entirely. And if they sit out of the credit market entirely, first of all, they have no chance to start building a better score and demonstrating their responsibility to future lenders. But they're also not borrowing in terms of increasing how many consumers are taking out loans to those that wish to make loans available and earn money from the provision of loans. So Ascend actually, like the name sounds, envisions folks on essentially a staircase where they can start out with a loan that is as fair as possible given their current low credit score, and then very carefully works to track their progress through digital technology and understand their behavior and their responsibility in repaying the loan, so that over time they can find increased ability to access more credit and decreased rates as their demonstrated ability to repay continues. And so that means not only better rewards for the borrowers and lower interest payments over time and more access to the credit that they might need to get their financial life in order and get their financial goals on track, but it also means that we're bringing more and more consumers into the credit market who might otherwise be marginalized and only using either extremely expensive alternative products or sitting out, and actually brings them toward more mainstream lenders and those that are looking to extend credit, say for something like an auto in the future, to folks that can build a better score and access a larger ticket item like that and finance something more significant. Another question we've been getting is folks are interested on the line in whether we're able to break down some of the results of this market sizing in terms of demographics. Do we know anything about generational or regional or ethnic trends in terms of who are using which products more often, or where the underserved are concentrated? So while this report doesn't break down to that level, there are certain products that do show some significant trends there that we can see. One is definitely in prepaid cards, especially the general purpose reloadable ones. We're seeing more and more over the last few years, and a study by the Federal Reserve Bank as well, we're seeing more and more millennials and younger Gen Xers using prepaid cards across the spectrum, both those who are underserved and those who are more fully served and making above what would be considered a low to moderate income, up into the 60s, 70s, 80s, even $100,000 in household income a year. And recently, the Federal Reserve, in fact, measured that over 50% of newcomers among millennials to GPR prepaid cards were making those significantly higher incomes. So an interesting trend there that both shows the comfort level that younger folks have with prepaid, and the fact that many people that do have fully serving bank accounts and other digital tools and financial tools at their fingertips still prefer to use a prepaid card or explore using a prepaid card for some of their financial needs, if not others, and are comfortable combining that usage with other types of usage in their lives. So I think that's one interesting example there. We also see regional trends for sure that are sometimes driven by regulations. Auto title loans would be one good example, as well as payday loans, of a place where there's a lot of variation state by state in terms of rates that are allowed and how viable those businesses are based on rates and other regulations that may or may not prevent heavy usage by consumers. So for something like auto title loans, you see a lot of usage in the southeastern part of the country, as well as some other scattered states at a higher rate than the country as a whole, just based on the regulatory climate in those areas and how many storefronts as well as players at the company level are in that space. Any other comments on the line that you look at from the Core's perspective or Morgan Stanley's in terms of understanding the types of people that use different financial products or are most interested in some of the newer things coming online, whether that's marketplace lending or subprime loans or newer payments products that rely on digital rails?
Yeah, it's interesting. I think we invest in such a wide array of product types and products categories that are more or less relevant, kind of depending on stage of life, relative level of asset accumulation, kind of financial needs at that given point in time. That we are across our portfolio. I think we see a fairly healthy diversity of profiles. But I mean, so I think segments that oversample, especially as you're talking about credit, would be categories where individuals not only necessarily, maybe have poor credit, right? We typically think of kind of the subprime or non-standard borrower as someone that has damaged credit or poor credit. Very often, it's the case that actually they simply don't have much credit. They're thin file. They don't have an established history. And so when you think of the demographic person that would fit that characteristic, well, that was me when I was coming out of college at 22 and had always just spent off of my debit account and not built up a credit history, right? So you have recent college graduates. You have recent immigrants, folks that are relocated to the United States, and across, interestingly, really all spectrums of socioeconomic strata here. So, anyone from kind of a doctor and engineer down to someone who's working sort of as a day laborer are going to really struggle to come to the United States and get a mortgage, get an auto loan, get a credit card because they don't have an established footprint here. And so that creates like a very interesting opportunity for companies that are looking beyond kind of the traditional signalers of credit and looking into kind of supplementary alternative signals. And so two of our companies in our portfolio that actually really address both categories of consumer. One would be Opportune, which I discussed earlier. It's a small dollar credit provider, and they focus predominantly on the thin to no file Hispanic market. And so they are making small loans of $15,000 to $2,000 to individuals who really would have absolutely no other credit option, and they are able to do so at APRs that are a tenth of what the industry average is in that segment. And they do so by being pro-consumer, by knowing how to underwrite that segment extremely well, and by structuring their products in a way that makes it possible for consumers to repay the loan, in a fully amortizing, extended term basis. So Opportune is a great example of a company that has really kind of arbitraged that gap in the market and figured out how to underwrite it there and kind of find the diamonds in the rough, so to speak. And that's obviously a huge market in the United States, right? Looking at demographic trends, like that is a large and growing market. And then another company in our portfolio that I think is super relevant to kind of the millennial segment, right? The recent college graduates or the folks that came of age kind of in the nadir of the financial crisis, 2008, 2009, 2010, who were quite risk averse around the concept of debt, who maybe didn't have kind of the easy access to employment that prior generations had coming out of higher education, and as such, we're just in a much more kind of financially tenuous place. Those are individuals that have also really struggled to build credit over the past several years, and it's a huge, again, demographically, millennials are a huge segment of our society. And so when you think about, how else might you be able to parse out the credit worthiness of that segment, so Vouch is actually looking at social network as kind of a predictive indicator of ability to pay. So if you are able to go out to your network and individuals in your network say, yes, Eva, you're a great credit risk. I've known you for 5 or 10 years. You're super dependable, super reliable. I vouch for you. You're great, right? They take that as a positive indicator of your ability to repay. So they're really able to serve that market, again, at much, much lower rates than those individuals would be able to get elsewhere. So I think those are just two kind of, the immigrant thin file dynamic as well as millennial dynamic are two interesting things we've seen play out.
Yeah, and from the Morgan Stanley side, very briefly, we are seeing increased amount of scale with a number of marketplace lenders, whereby we've structured, warehouse and securitization facilities. We've also done private debt for some of these types of companies, and also underwrite through our investment management business some debt as well for some of these types of fintech companies. Obviously, the firm is quite keen to, win IPO mandates, but sort of in the interim, we're seeing kind of a plethora of new entrants that are growing with enough scale and that have the proper risk management in place for us to, get credit agencies comfortable and investors interested as well. The one thing I will mention is that, there are, a handful of, kind of more hedge fund kind of investors who are also kind of exploring some of the disruption that's happening in this segment. I would say perhaps in my observation a little bit more on the international side. But all that to say is I think there are pools of capital that are interested in this segment, and we're here to sort of help help those investors and companies navigate the spectrum of opportunities.
Thanks, Moses. I think that adds some really interesting color there to what Morgan Stanley's focused on. With that, we want to come to the end of our presentation today. Thank you all for listening. For those of you whose questions couldn't get answered today, we will try to follow up individually if there's anything that you're curious about that was not covered here. We have all your questions recorded in our format. And I want to encourage you all to sign up for CFSI's newsletter to make sure you see the report when it comes out next week on Tuesday. And already right now we have an infographic available online that you can download from the address on the screen to see a bit more about what's going to be coming out in the report and some highlights. And this presentation today will also be made available to you as a recording after we are done today. So look for more information to listen as a recording and view the slides after we are complete. I want to thank you all for attending, and also big thanks to Colleen Poynton from Core Innovation Capital and to Moses Choi from Morgan Stanley for lending their wonderful opinions and insights to us today on the line as well. And for more information about Core Innovation Capital, you can advance to the next slide. You can also go to corevc.com to learn more.